Let's talk about DCA, or stands for dollar cost averaging. You can see I just wrote that down right here. Dollar cost averaging, or DCA. Listen, it's a fairly simple subject, but I'm going to try to dive into it a little deeper than most, maybe because, here's why. I'm a trader. I've been trading for a while. Don't get me wrong, I've gotten crushed on some trades, and there's been times where I've actually had to step back and go, you know what? Dollar cost averaging is absolutely the better strategy than trying to trade. It's also sometimes just the better strategy than just buying, like here's the price right now, I'm just gonna buy, I'm all in all at once. Maybe it's better to plan something out, think deeper, build for the future. Dollar cost averaging. So what does it mean? Well, it just refers to dollars. You're taking your dollars and you are averaging into a position over time. So you are buying over time. You are averaging into it. Over the next 10, 20, 30 years, you're going to have an average buy price, and you're just slowly going to be buying. And let's just get into an example. So the chart that I actually have right now to show you this example, to walk you through it, is something called VT. And VT, this is the symbol VT, is a Vanguard ETF, all-world equity fund. So it's a mixture of all sorts of mega cap companies across the world. It tries to get you exposure to all aspects of the world, whether it's North America, Asia, you name it. It's just fill in the whole globe. And let's say you want to get exposure to the world over time. And as I was saying earlier, you could just jump in and buy all at once. But what happens if the next day there's a little bit of a meltdown and you wake up and you're down 10%? That's not going to be a great feeling. Then you have to sit and wait, see if things come back to normal. You're going to be checking your phone every single day. Just have some patience, build a plan, dollar cost average. Now, some people dollar cost average over specific time frames. So I'll give you a great example of what that might look like. Someone might say, you know what? I'm going to buy 5%. I'm going to take 5% of my cash every 30 days and buy a chunk. I don't care where the price is, but I'm going to buy. And so I put these vertical lines here just to sort of show as an example. You would buy here, then the days pass, you buy here, days pass, you buy here, days pass, you buy here, here, you kind of get the idea. You're just buying no matter what after a set period of time, because you believe that price action is random, but you do believe in the long-term trend. And so let's just say price follows this direction. You bought there, then you bought here, then you bought here, then you bought here, and then it's back to here. And so what you've done is you have bought the average, you've bought at each of these moments in time, and now you can average up the price you paid at each of these moments in time, and you get, the average price paid. And the point of that is during drawdowns, so this may look a little confusing, but during drawdowns, just stick with me, if price goes down, because you're buying no matter what, right? That's what these lines are. It's the increments. Every 30 days you're buying. Because you're buying at lower and lower prices, you're actually lowering your average cost. So then when it spikes, guess what? Your average cost went lower. That means your profits are greater, and you've just decided to build this strategy over time. So that's what's really important about this process, by the way, is one, you've agreed to yourself, to your financial planner, to whoever that you're going to buy at specific periods of time, and you automate it. And the lines on this chart just show you space it out. Every 30 days, buy. I don't care what price is. Every 30 days, buy. I don't care what price is. And if we really zoom out and you look at all these lines, and this, by the way, says 2023, I think all these lines show how impactful this can be over the long haul. Because every vertical line on this chart is a point where you would be buying no matter what. So you can start to see like, whoa, that might have been a big position over 3 to 5 years. It may not feel like a lot now, but over the long haul, it can make a huge difference. And the circles I'm making on the chart is I'm just trying to say it could be totally random. You don't know where price is going to be. That's sort of why you've agreed to yourself or to your financial planner that you're going to buy no matter what every 30 days, because maybe you're just going to get these price entries. And even though it looks chaotic, you can kind of see, let's turn this line to a darker color. You can kind of see the average of all these buy points is potentially better than just buying all at once and just taking your time. There's also some comfort in knowing that you're taking your time, that you're sticking to a plan. Even better is, why risk all your cash at once when you can feel that extra level of comfort knowing that you have this long-term plan ahead. You got your cash here. You're buying every 30 days. It could be 20 days. It could be 10 days. That's one example of dollar cost averaging. That's just one example. So let's write that down. Dollar cost averaging. We can make sure we put this in the notes, dollar cost averaging. So that's a buying every 30 days. For example, it could be any time distance, but you're buying on repeat or automated, regardless of price. So that is one example of dollar cost averaging. Now I want to talk about something that's a little more complex, and this is where I hope if you've stuck around, maybe you'll get a pleasant surprise here. And let me make sure I move this over here. Maybe you'll get a pleasant surprise here, because this is where I hope my dollar cost averaging strategies help you. Now, you can do a lot more than just buying every 30 days. What you can also do potentially is buy on a time-based interval, but on specific drops or drawdowns or crashes. So I'll show you a quick example. Here's price right now, 95. Well, you have your dollar cost averaging system set up, but instead you could say every 10% drawdown you want to buy, every 10% drawdown. So now it's not so much time-based as it actually is, price action based. So now your goal is to get into every dip after 10%, but you're only allocating a small percentage of your portfolio. So let's write this in. You can buy every 30 days. You can also dollar cost average. Let's do dollar cost average into dips, a set system that buys after specific drops, panics, crashes, you name it. So you build a system that just sits and waits. You automate this fully. Every 10%, I'm going to buy. With 5% of my cash, I'm going to buy. If it drops another 10%, I'll take 5% more and buy. If it drops another 10% more, I'll take 5% and buy. And so now you're just buying dips. Now, what's tricky about this strategy is, what if the market just goes straight up and never has a 10% drawdown? That kind of happened here. You may not have gotten in at all. So you can start to actually combine some rules into that, where you're just buying now based on not only the dip, but with some sort of time frequency. So buy at minus 10% or every 30 days. So whichever one comes first. Quite unique, different. I doubt you've heard of that before, but that's where you can start to build this plan. And it's up to you to think through that. I'm making this video just to share some of my thoughts as someone who's been through this before, has tried it all, and especially because as a trader, whoa, have I seen some volatility. Don't get me wrong, made some good trades, but also some terrible trades. So I like sharing this because it also helps me think out loud about strategies that I eventually would like to, try in more detail. And I figured making these videos to help others, heck, it also will help me talking out loud, and hopefully you leave feedback in the comments with your thoughts on this. So now you can see what we'll do is we'll add these lines here. Now you can start to see what happens if you're buying every 10% dip. We'll just lay out these lines. So you essentially would have gotten in here and here and here and here, and then take the average price of all these dips. Now you are buying on the basis that it will continue upward. There's no guarantee in markets. But by waiting for these dips, arguably you're kind of becoming someone who's only buying moments of panic. There's those famous Buffett quotes about, buy when there's blood in the street. And that's not easy to do. But if you have a system like this and you have the patience to wait, you can absolutely create this yourself. And as a great example, if you remember the coronavirus crash of March 2020, let's just see how many buys you would have gotten in during this time. Let's take it from the high. So there's one. This is the 10% example. You would have got one buy minus 10%. 2 buys minus 10%. 3 buys minus 10%. Would you have gotten another? You may have, looks like you've gotten one more. Wow. So you would have not, under a system like this, you would not have had many chances to get into the market. But during these moments of panic, you would have had 4 pretty fantastic purchases, that you were waiting for as a part of your system. You just dollar cost averaging in every 10%. And sure enough, you take your average price and you see where markets are now, and that would have worked out pretty well. Then, of course, if it happens again, 10% would take you to here and you'd buy it. So that's an interesting strategy. Now, I have a third one to share, by the way. I have a third one. So dollar cost averaging into dips. And then let's do, this is the last one, dollar cost averaging based on your investing or trading style. Okay, this one's a little more complex, but let's say you're a trader. Let's just say, in my shoes. And I love moving averages. And I'm going to go to a daily chart. And I'm just going to say, I buy, let's do this, indicators. I buy every time this asset hits its 200-day moving average. 200 days. So I only buy when this asset is the same price as its 200-day moving average, and the 200-day moving average is the average price of the last 200 days. And so now you can start to see what that would look like. And maybe I only do this, once every month if it happens, or maybe I do it all at once, right? This is up to you. There's no easy answer in markets. These are systems you have to build for the long haul. So this blue line, if price were to hit there, I'd buy. It looks like back in 2020, I would have bought. I also would have bought in March. Granted, that would not have gone so well, but still it's part of the system. I also would have bought here in 19, again in 2019, and again in 2019. But you can see the average price that I would have paid following this strategy, which is about 73, and the current price is 94. That's not bad. And that's just a system that I created based on my personal trading style. So you can kind of see where dollar cost averaging does not always have to be a boring, long-term, I don't know what I'm doing, just fundamental investment style. You can actually mix it in with some trading strategies. And this video, I hope, opened your eyes up to that. And like I said, please write in the comments your thoughts on this. Dollar cost averaging based on your investing or trading style is point 3. And one more example of that is, let's say you want a dollar cost average actually into an equity symbol like Apple. You're just buying one symbol. Well, one thing that you could do under this example is you could look at its financials and you could pull up its PE ratio. So let's see, PE ratio, price to earnings ratio. It's just an example. And you could say, I want to buy every time its price to earnings ratio is below 20, or if it comes back below 20. So now what you're doing is you're building a strategy that is only looking at its fundamental picture, and you're buying based on those ratios. And you remember that this could be anything. You could do forward PE ratio. Why don't we do that? Let's do forward price to sales. That's a popular one. Let's do forward price to sales, and let's only buy when its forward price to sales goes below 20. So we would have a buy order if this were to drop here. Remember, this could happen for 2 reasons: whether price really dips and brings this number below, or if they have an earnings report. and you could build a system around something like this. Okay, this was a long video. I hope you stuck around for the whole thing. The whole point of it, though, was about dollar cost averaging. We can go over the final notes that we took. Dollar cost averaging, buying on a time frame every 30 days, for example. You just buy, automated. You don't care about the price, and over the long haul, that's the investment that you do and the strategy you take. 2 is your dollar cost averaging into dips. So you have a set system that's only buying during drops, panics, crashes, and you can simply mark a number. So if you remember the example, you can mark the number from its recent price to now. I buy every 10% dip, that type of thing. And if it happens again, you do it again. And if it happens again, you do it again. And then lastly, you can dollar cost average using a trading or investing style. So following some strategy that's unique to you. We sort of showed you how that's possible if you were to use a fundamental metric like price to sales ratio, or if you're using the 200-day moving average example. So I hope this video helped, and I look forward to hearing what everyone else says about it in the comments below. It's not an easy subject, and thanks for watching.